Welcome, everybody, to this week's edition of Reverse Mortgage Weekly, where we go over the reverse mortgage program and really try to explain this program in an easy way so that people can make an educated decision when they're looking at possibly doing a reverse mortgage. I really believe in education. I think that one of the best things that we can do for ourselves is to become educated. It's kind of fun, too. I love the fact that if you are seeking wisdom or seeking education, it never ends. Never ever can that end because there's so much to learn, and try to learn something new every day. So this is our weekly webinar that we put on to go over the reverse mortgage program. So let's go ahead and get into it. Well, my name is Zach Smith. I own Chariot Financial, and I have been in the mortgage industry for 21 years. I've been an owner of Chariot Financial since 2019, so we're going on 5 years. I worked for a lot of the big banks. Previously I worked for Chase Bank and Fairway Mortgage and some of these larger institutions. But I have found that going off on my own has been the best decision that I've ever made, and mainly because I'm not focused on just one product. A lot of times when you go to the bank or you work for a big bank, you have just a set amount of products, and that's all you got. And if the people don't fit inside that box, well, then you're not able to move forward with it. For example, a lot of people think that there's just one type of reverse mortgage, but actually there's several types of reverse mortgages. One of the types that I was inquired to about this week was the proprietary program that is offered by some banks. Now, not all banks offer this program. But what it is it's not an FHA reverse mortgage. It's more like the reverse mortgages of the past. Now, without some of the bad things that those had. Once the government got involved and once these got reformed as far as a reverse mortgage, things really changed with the guidelines, and really a lot of protections were in place. But the proprietary program is much different because with a reverse mortgage FHA type program, well, you have to pay a 2% upfront mortgage insurance premium. That's one of the things that people don't really like about this program, is that there is an upfront mortgage insurance premium. So if you have a $600,000 home, FHA is going to charge you 12 grand to originate the loan. Now, that's not coming out of pocket. And of course, if your house appreciates in value 2% year over year, you're going to make up for that right away. But it's still a cost that you have to pay when the loan is due. And the loan is due when you move out of the property, whether it's that you just move or you get moved into a facility or that you pass. At that point, they would want the loan to be paid. Not right away, but it is that is one of the conditions for repayment, is that you're no longer living in the property. But I was asked about that program because the closing costs are much, much less on those programs. So the caveat, though, is that the interest rates are usually a little bit higher. And does the interest rate really matter with a reverse mortgage? It can. If you're going to be in the house for a long time, or if you have heirs that you want to make sure you leave equity to, it definitely is going to come into play. But an interest rate really comes into play on a forward mortgage, because if your rate goes up, guess what? You're going to have to come out of pocket much more. I mean, look at what we're dealing with right now in the housing market right now, with rates going into the sevens last year. What that meant is that very much fewer people were willing to spend money on a mortgage or go out and purchase because the rates were so darn high. So with that being the case, the situation is that they have to come out of pocket. If you got a higher rate, well, all of a sudden you got a budget for that. Well, with a reverse mortgage, there's no required monthly payment. So if the rate goes up, does it really matter? So it's really a question of what's important to the client. That's why I've always thought that in sales and really trying to be of service to people, the best thing that we can do is basically be silent. Because if you're silent, people will tell you everything that you need to know in regards to how to serve them best. And you get to find out a little bit about their goals and how to help them accomplish those goals. So, yes, so that's one of the great things about being a broker, is that I have access to a lot of different banks that have different programs and things of that nature. So we're not going to go over this whole presentation. We're actually going to skip through a good portion of it. The first part of this presentation we did actually 2 weeks ago during this, so this will be on our YouTube channel or our Facebook page, so you can find them both there. They're both recorded live, so you can access those. But really just going over some of the myths about the reverse mortgage and what I've heard from some clients over the years, and just to kind of set the story straight in regards to those. So we're going to jump into why do they exist, how do borrowers qualify, and what do they look like long term, as long as we have time. We hop on here for 30 minutes every week, so sometimes we have time to get through everything, but we'll go ahead and start with that. So this is what we went over last week. Basically, these are some common misconceptions about the reverse mortgage. It's a government takeover of your home. It's a scam. It's hard to sell your property. You'll go upside down, lose title to the home. You'll leave little to your kids with debt. None of those are true, but these are the top 6 that we hear as professionals on a daily basis that originate these loans. And none of them are true. None of them are really accurate at all. So the one thing that people don't like about this program, which I alluded to, was that the upfront mortgage insurance premium. So it's a 2% charge. And again, it doesn't come out of pocket, and you'll probably make it up if your house appreciates 2% year over year. But it's still something that you have to pay back. I mean, there's no way around it. You can't really sugarcoat it. So let's go ahead and move on here. Okay, so let's go to what a reverse mortgage is. Let's go ahead and start there today. So a reverse mortgage is a loan. Surprise, surprise, it's a loan. You do have to pay it back. It does have monthly payments. They are optional. There's a light qualifying, so income, assets. There's a light meaning that, because there's no monthly payment, how do you determine the risk on a reverse mortgage? That you determine the risk on a forward mortgage based on someone's income, assets, and credit. Well, if you can't make the monthly mortgage payment, then the bank won't approve you for that because it's too big of a risk. Well, with a reverse mortgage, there's no required monthly payment. There is a monthly payment, it's just not required. So basically what that would look like is the risk is determined by your age and by the time. So there is light income qualifying. If for some reason someone is not able to qualify for a reverse mortgage based on them paying their taxes, insurance, all of those items, because they got to make sure that you're able to survive, provide maintenance on the property, things of that nature. But if for some reason you're not able to qualify for those, they will set up what's called a LISA account, which is a life expectancy set aside. So basically what they're saying, it's a really fancy name for an escrow account. So they would basically pay your taxes and insurance for you out of this account. So you got to pay your own taxes and insurance. So that's something that you have to do. There was a lot of uproar about this program because they're saying, it's a bad program because, someone wasn't paying their taxes and, they lost their home because they didn't pay their taxes. And then they blame the reverse mortgage and they say, well, it's the reverse mortgage, go get them. And people get out with their pitchforks and they go run out. But not quite. Kind of, though. That's the essentially the idea. But the thing is that it's such a bad way to picture a situation with the reverse mortgage and say that it's the reverse mortgage's fault. But this is the information that people are receiving. If you don't pay your taxes on your property, it doesn't matter if you got a forward mortgage, a reverse mortgage, no mortgage. It does not matter. The taxes are something that you have to pay. And with a reverse mortgage, you do have to pay them separately, unless you set up a LISA account, like I mentioned earlier, which can be set up. I mean, we can do that for our clients if they, most clients prefer not to do that. They just want to pay the funds out of pocket, which honestly to me makes more sense, because why would you want to give the bank access to your cash in an account that you don't have access to? So I always think, and this is really a big part of the premise of the reverse mortgage, is basically putting people in the driver's seat with their own money, with their own cash. Once you have a forward mortgage, if you're paying that mortgage each month, you don't have a choice. That payment is due. So you have to make that monthly payment. So with that, with the reverse mortgage, instead of making that monthly payment, if you want to make the monthly payment, you can. Or you can take that cash and put it in your pocket. I think people do very much better with the cash in their pocket than they do with the cash in the bank's hands. But I'm sure someone would argue that point somewhere. And again, it is a FHA, and proprietary programs are available for this type of loan. Now, why are they so popular? There's roughly 480,000 homeowners with a reverse mortgage, and more are growing every single day. Well, number one is cash flow. I mean, that's really the name of the game. Most retirees have reduced income in retirement, and mainly this is due to being on a fixed income, like Social Security or a pension. Inflation, cost of living has gone up. And there's oftentimes there's an abundance of equity, whereas there's not a lot of cash coming in, but there's a lot of equity there. So how can we, balance things out so that you can access some of that equity and supplement your cash flow? Well, in comes the reverse mortgage. So how can people access or unlock cash from the equity in their home? Well, the first thing they can do is they can use a combination of any of these, actually. They can use a lump sum. So you show up at closing and a guy with a suitcase handcuffed to his wrists shows up with a big thing of cash, and I'm just kidding. It doesn't happen like that. But what they can do is they can issue you a check or a wire transfer at closing to your bank account or however you want to set it up. Secondly is the line of credit. Now, this is the most popular program, and honestly, I think it's the best way to use this program is the line of credit. Now, again, we are here to help our customers get exactly what they want. Some people don't want a line of credit, but most people do, because it really gives you a lot of security in regards to your financial situation, knowing that you can access cash from this line of credit if you need to. Now, if you don't need to, then you can just let it sit. Just let that sit and accumulate. It all actually grows over time, the line of credit. So people really, really like that because it does act as a financial safety net for you. And then the last way you can use this program or access cash is by getting payments back each month from your mortgage. So it's almost like turning your home into an annuity that pays you back each month. Now, a lot of people don't choose that option because you don't get back as much as you think you would. So let's talk a little bit about equity. I mean, that's really the whole thing here. So basically, equity is great to have, but it's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. It's not like you can take a picture of your house and go down to the bank and pay your mortgage with it, or pay your groceries with it, or whatever the case is. So equity is basically cash that you can't access unless you sell or you take out a loan and pay it back with interest. So does it really benefit you in retirement? Not really, mainly because it's not liquid. Is it better to pass on a higher net worth or more equity? That's a question I like to ask a lot of my clients, and I would like to ask a lot of people is, do you want to pass on your house with equity, or do you want to pass on a higher net worth? Because if you work things right and you can really crunch the numbers on this, and they've done a lot of research on this, and we'll go into a little bit, you actually end up passing on a higher net worth if you use your equity first. Most clients and most people create a situation where they run out of assets first, and then they look to the house, and they're like, okay, well, we can sell the house. We're out of assets. We can sell the house and rent. But that's, I don't see that that's a great option, because if you sell your property, then you're going to rent. If you're renting and you're paying $2,000 a month in rent, you're still paying a mortgage. You're just not paying your mortgage. So oftentimes people, clients, and financial planners make a decision to basically run out of all the assets and then sell the property, where really you should be pulling out of that equity first. And if you do, the survivability rate on your assets is going to last much, much longer. So, and I've always thought that cash does better in your pocket than it does paying off the bank. As far as paying off a loan, that's what we've been taught traditionally. And there's nothing wrong with that. I don't like to have debt. And I think that a lot of the folks who are beating that drum about paying off debt are absolutely 100% correct. But this is the thing. We got to be smart about it. The 30-year fix is a raw deal for the customer. It really is. And that's the most popular loan. I mean, that's 99% of mortgages are 30-year fixed loans for the residential space. Well, you know how much interest you're paying on a 30-year fix in the first 10 years? You're paying 50% of the interest in the first 10 years. So, folks who are looking to, really make sure they utilize their funds wisely, I don't know that it's wise to pay the bank 50% of the interest on a 30-year term in the first 10 years. For instance, on a $600,000 loan amount at 6 1/8%, your principal and interest payment is going to be somewhere around $3,600 per month. So if you pay $3,600, guess how much is going to pay off your loan? $600 out of that $3,600. And I'll give you a wild, crazy guess where the other $3,000 is going. You guessed it right. It's going right into our bank's pocket. So again, I've always thought that, to look at these things from a different perspective can really open things up for folks. So let's talk a little bit about the three buckets of finance. We have income, we have assets, and we have home equity. So income is basically what you're making during your pre-retirement. Now, these are the pre-retirement figures. So you have income, you're saving, you're putting money into the yellow bucket, which is your assets. So you're, saving in your 401k, your Roths, all that stuff, IRAs. And then you're also paying down the balance on your home. So that's really what things look like. You make money, you save it, you pay your debt down on your house. Well, these things take quite a bit of a turn in retirement. So the first thing that we notice in the post-retirement buckets here is look how tiny this red bucket got. Well, now folks aren't making as much income as they did when they were younger. And so they're in a situation now where they're not bringing in as much as they did previously. Well, let's look at the yellow bucket here. Well, now the yellow bucket has this throne that it's sitting in. Well, basically, the reason that becomes sitting in a throne is because it becomes vitally important when it comes to planning your financial future. Because the biggest fear that a lot of my clients have is running out of cash. And it's a real fear. The thing is that we don't know how long we're going to need our nest egg for. We could live to 60, we could live to 70, we could live to 80, we could live to 90, to 100. Well, the difference between 70 and 100 is 30 years. So, you don't know how long you're going to need that cash for. So it really becomes a crown jewel. And if it were up to me, none of my clients would ever have to even touch it. They would basically pass that on. And then the green bucket's just kind of sitting there. It's got a lot of equity. You've got your home equity there, and it's abundant, but it is idle. It's not really doing anything for you. It's not going to work for you, so to speak. So does it make sense to pay a mortgage in retirement? Well, again, if you are, you may be taking from your life savings or from a limited source of cash flow. A good example of that is the clients that we have that are depleting their life savings every single month. And sometimes folks only have $5,000, $6,000 left, and they're taking money out of that $5,000 to $6,000 account so that they can pay their mortgage, which is essentially, as we just learned with the 30-year fixed, is basically taking their life savings and handing it over to the bank in interest. That's a recipe for disaster. And that's not something that I would want anybody to make a decision to do. But because we're in a situation where we don't feel like there's any other options and we're not willing to look outside of the box, well, we end up exhausting all of those funds, and then we have to sell the house, rent, go into facility. It's just not the quality of life that I would want for my clients. So basically, if you're doing that, in my opinion, it's just not a good recipe. So what is the deal with Americans and their obsession with a 30-year fixed mortgage? Again, we just talked about that. It's a raw deal for the client, but it's a great deal for the bank. It's a great deal for them. They're getting a lot of our money in interest, and it's not a bad deal for them. So again, 50% of the interest in a 30-year fixed is paid in the first 10 years. It's a great deal for the bank, not so for you and me. Should you hand over your hard-earned retirement now or later is the thing. So basically, what that means is that should you start spending your retirement funds now so that you can pay a mortgage? It just doesn't make any sense to do that. Now, if you're living debt-free, mortgage-free, that you're in a great situation. I do have several clients that will still take out a reverse mortgage. Why? Because they like that comfort of the safety net of the line of credit. Basically, line of credit can do a lot of good, and we can kind of go into some of that here. Reverse mortgage is a retirement tool. Too often, all of us focus on the price, the cost, instead of the value. For a retirement plan, as any endeavor, it is important to assess what the goal is, not just the small pieces of the effort. Very few people have the goal of dying with the most equity in their home, but most advisors and clients make decisions that reach that goal by default. In reality, it doesn't make any sense to put hundreds of thousands of dollars into an illiquid asset during our retirement years, but our culture is very used to doing just that. So if I offered you a penny that doubles every day for 31 days or $1 million, what would you take? So this is basically an example of exponential growth. Well, you want to take the penny, and here's why. If you take the penny, that penny is going to be worth over $10 million in 31 days. 1 penny, 2 penny, 4 penny, 8 penny, 16, 32, 64, all the way up to 31. Now, this is just kind of a gross example of how exponential growth works. But this is exactly how our retirement accounts work. The longer you keep those funds in, the more it will grow, the more you'll be able to obtain over time for your nest egg. But if you take this penny out of 15 days, it's only worth $163. Same thing with our retirement accounts. If you start withdrawing early or withdrawing more than you think you should at that time, then it can really impact the amount that you have long term. And again, the idea is to save that nest egg for as long as you can, because we don't know how long we're going to need it. So here's some HECM strategies for portfolio coordination. So basically, this is a chart that shows if you're investing or if you have investments and you have a reverse mortgage, does it make sense to work with your equity first, with your home value first? And in every single instant on this graph, you see that it was actually more beneficial to take out a home equity or a reverse mortgage earlier than later and use the home equity before you use the assets in your retirement accounts. In every instance, your retirement accounts are going to do much, much better. And this is the thing. The thing about your retirement accounts is that if you need the cash, you can get it. If you need the equity, there's no way to get it other than doing a reverse mortgage, a regular mortgage, or selling the property. So having that already in place really creates a lot of peace of mind. And that's the number one reason why people enjoy and love this program, is the peace of mind that it brings. For some folks, that is priceless, I being one of them. So reverse mortgage line of credit, it does grow over time. So let's say you have a 72-year-old client, home value is $460,000. Available line of credit is about $209,000. Over time, the home value is going to balloon to $1.1 million, and his available line of credit would be actually $891,000. So the reverse mortgage line of credit is going to go up in value year over year. So this is an example of how that amortization looks. So basically you have a line of credit that starts off at 209, and then in 10 years you may be able to access 339. In 20 years you may be able to access 580. And 28 years you might be able to access 891,000. So that's one thing about the reverse mortgage line of credit that some people don't talk about or even realize, is that it's almost like having a second growth account that you can access. Now, it only grows on the amount you don't take out, but it does grow over time, which is very unique to the reverse mortgage line of credit. For instance, on a normal line of credit, that's not offered. So let's look at a passive strategy. Now, this is just data that was taken from 2000 to 2018, so a little bit outdated. But if someone were to have $1 million at the age of 62 at 2000, if you took it out and they made a withdrawal of 5.5% year over year, after 18 years, they would be basically at $111,707 that they would have left. Now that's at 80. What if this fellow lives to 100? You know, he's got $100,000 to live off of for the next 20 years. It's just not a very good situation. It's kind of like taking that penny out at the 15-day mark. You're not allowing that property to grow, or that or the accounts to grow. Now this is an example of a HECM strategy, coordinated strategy, where on these down years, in the early 2000s, we had some down years, had some down years in 2008. Now, the only difference between this strategy and the other strategy is that during those down years, instead of drawing from his retirement accounts, he's basically drawing from his home equity line. And by doing that, at the end, when he's 80, he actually still has $828,000 in the bank account. Now, yes, he's got a lien against the property now because he's been drawing those funds. But the fact that he still has $828,000 in liquid assets is a huge advantage for most people. So this is just an example of a traditional mortgage versus a reverse mortgage. And basically what it's saying is that, hey, when you're paying a forward mortgage, not only are you paying the mortgage off, but you're paying all the interest. For instance, on a $200,000 balance, and again, the interest rates and things like that, these are all just arbitrary amounts. So don't get too technical on me here because the rates are going to change, but the concept is the same. So $200,000 balance, you're going to end up paying $364,000 in this scenario for that loan. So yes, you borrowed $200,000, but you got to pay the bank $364,000. So they made a profit of $164,000 in interest if you follow through with their program for 30 years. And again, 50% of that $364,000 or $164,000 is being paid in the first 10 years. So they're getting their money up front. So property value at a 4% appreciation goes to 1.4 over those 30 years. And you have a net gain of about $1 million because the property has increased in value so much, but you're out of pocket $364,000. Whereas with a reverse mortgage, let's say you'd had the same scenario. With a reverse mortgage, you have the payment optional program. So what that means is that if you want to make a payment, great. If not, then you can just let the balance increase. So let's say you let that balance increase for 30 years. It's going to balloon all the way to, let's see here. It's going to balloon all the way to, well, this would be your property value. Well, that loan, reverse mortgage balance, $1 million. It's going to balloon. I was looking for it the whole time. It's right there. And let's say you, instead of making that mortgage payment, you put into a 7% investment that you make 7% year over year. You're going to gain about 1.1 million. So you have a net gain of about 1.5 million. Whereas if you did the traditional route, you'd only have about $1 million gain. Still a very modest gain. I mean, you'll take it, right? A $1 million gain on your investment, this probably sounds pretty good. But you could have 15. And again, that's why we asked the question, would you rather pass on a higher net worth or more equity, or equity or a higher net worth? Generally, people want to pass on a higher net worth or live more comfortably the last 30 years of their life. Well, that's all we got for you today, folks. Hope you have a great rest of your day. And if you have questions for me, you can reach me anytime at chariotreverse.com, chariotreverse.com, chariotreverse.com. Thank you so much. We'll talk to you soon.